Okay, for sure. Thank you. Thank you, Andrew, for introducing me to the team. And well, I look forward to meeting Gary soon in the near future. So it's my pleasure to bring value to the table. So good afternoon, ladies and gentlemen. Thank you for attending today's session where we're going to be talking about the opportunity for personal real estate corporation PREC from the financial planning perspective. Here is today's agenda. So because it's the long weekend and also statistically speaking, we do lose the attention after an hour. So maybe we could keep this around an hour. And if you guys want more sessions in the future, let us know and then we can arrange something like that. What do you say, Andrew?
I think that's perfect.
Perfect. So let's do a little recap of what was said from the last time. And then we're going to be focused on the opportunity. Who are PREC for? What makes good great? How does that work? And once you've decided to incorporate your business, let's take a dive into understanding it more. What are the tax efficient solutions on the table? And how does passive income work within the corporation? We'll be presenting some strategies and looking into the business planning overview together. So who am I? I remember meeting some of you from the Christmas party last year at the convention center, and then some more at the gala hosted downtown. But for those who I haven't had the chance to meet yet, my name is Vicki Lin. I'm a holistic financial advisor at Sun Life. Here is what I tell my clients. I do not work for Sun Life, but Sun Life works for me. Why? Because I'm a business owner, just like you guys. Sun Life provides me the support and resources when I needed to grow my business. Just like Kelly William, see how quickly you guys are able to pull together on such, like the three of us on such a short notice. A little background of myself and my loving family. I'm a mother of two. My husband Joe is a realtor like yourself with Kelly William in Ottawa, who is always busy on the go, especially on the weekends. We love to work hard, but play harder. Let's not get into too much details. I refuse to bore you to death before your insurance is in force. Okay, why did I say that? This was what happened to me and our family 4 years ago. This is a little bit personal, but it was definitely the scariest moment in my life. The thought that came into mind, knowing that the car was about to crash, was what's going to happen to the kids if I die? What if? My husband Joe and I had not thought of life insurance or any kind of insurance at that point. We lived happily together, spending all the money we made and never thought about the risk or the future. What if? What if it's too late or too expensive? So today is all about you. Let's get started with what's changed in Ontario. The corporation is referred to as a personal real estate corporation, PREC. A PREC is a corporation that a salesperson or broker may establish that is permitted to directly receive from a brokerage remuneration that is earned by the registrant. The use of the PREC may have beneficial for financial advantage for salesperson or brokers. Here are all the reasons. The reason number one is that it provides opportunities. It provides the opportunity to minimize tax, use a mix of salary versus dividend to the best advantage, and also income splitting. The second one is the limited liability. The basic advantage of incorporation is limited liability. So the third one is income stabilization, where are fluctuations in income earned from year to year. So that's where Steve had mentioned last time. How do we use corporations to smooth the income, not just today, but in the future? The last one is deferred tax. So tax shelter compensation plans such as registered pension plan cannot be used for the benefit of sole proprietors, but shareholders may be a member of such plans. Now, let's talk more about the opportunities today. The opportunity that PREC provides from the financial planning point of view. The first question is who? Okay, so here are some stats that show OREA has about 79,000 members. 28% of agents sold more than 6 homes. 10 sold more than 13 homes. And average commission is about 50 grand per sale. Top 10 agents would be able to make over 200 grand a year, and that's about 5,000 agents. So here, some of you might think, should I leave now if I don't make this much money yet? So I use yet a lot. This is something that I say to Joe. When I say that, it means that it is coming soon, and I believe in you. So no, don't leave. The better is yet to come. PREC opportunity goes to not necessarily only the high income earners in the industry, but also agents who make the money, who don't need to spend it all. So for example, if you're a housewife who your family could live off your husband's income, the philosophy behind the wallet is that his money is your money, but your money is still your money. In this case, I would say, call Steve right now and get your PREC started. Seriously, I'm not joking. Another example is that you might need to still spend some of your income, but you don't have to spend it all. So there are leftovers. Leftovers means retained earning. And the retained earning that constantly living in the bank, mostly not making any interest or generating any income in any sort. PREC could provide you a better opportunity to grow your asset and investment in the most tax efficient way. Now, here you're thinking and wanting to ask, Vicki, how do I know? Like, how do I know exactly where I am or even roughly? Great question. Let's look at something very boring here. This is a tax cheat sheet that when it comes to financial planning, I always show my clients to better know where you are in terms of income and tax. For example, income below 12 grand, you do not pay any income tax at all, period. For that being said, I hope no one here is that lucky. The reason you're spending time here with me and Tony is that you either make too much money or you don't need to spend it all, while hoping how to grow your asset in investment. Let's look at a bigger jump from $79,069 versus $79,070. The tax bracket goes up from 37.91% to 43.41%. So, in another word, if you should absolutely put that $1 into RSP if your accountant cannot help you to write off that $1 as any kind of expense, because that could save you $5,339 and paying tax. Do you need to know all of the numbers on this sheet? No, who cares? Like, the numbers are boring and it's so hard to try to figure out where to look at. Most of my clients don't. What they care about is how I could do to help them to minimize or defer tax. In your case, how do you put more money, your hard-earned commission, in your pocket? Something it could be overwhelming is that to listen to all of the people, all the professions, and trying to figure out what number to call, where to even finding the numbers. So our holistic approach is that we can put them everything together into a simple, efficient, and effective way. In fact, when I went to see Steve Parker the other day after his presentation, trying to figure out how we can work together as a team to help you guys, I had brought this sheet to him. So now all the details numbers are all in one place. A successful financial planning starts with a conversation. As you all know, the best way to get your clients start talking is by asking open-ended questions. So here are some of the questions that I ask my realtor clients, and those are some of the response that I've got. I don't know if you're interested to look into all the some of the things that I put in, but here is what Benjamin Franklin said. The only things of certainty are death and tax. But what does that mean exactly in Canada? Any income earned in the year up to the date of death must be declared on your final income tax return. You're also deemed to have disposed of your capital assets at the time of your death. A principal resident is, however, specifically exempt from tax on the capital gain. Your RSP and RIF must also be declared as income on your final tax return, except when you pass to a surviving spouse, common law partner, or financial independent child. Do you know how much is your death bill if you would die today? Okay, no one wants to talk more about death and tax, so here is what is exciting. What makes good great? You heard me right. You are still here because you are good. You're good at what you do as a realtor, selling houses. But what makes good great? Have you heard of the 80-20 rule? Because sometimes if this is like a in-person or interaction seminar, then I'll be able to interact with my audience. This is a little bit difficult, but anyways, in business, a goal of the 80-20 rule is to identify inputs that potentially the most productive and make them the priority. So for example, at Kelly Williams, the top 20 agents will make 80% of the income. Top 20 agent will make 80% of the income. So let's look at your house. The 20% of the clothes that are very comfortable in your closet, you mostly are wearing them 80%. Seriously, it's so true. But why is Vicki telling me all about this right now? Because you could also achieve more with less. Like you could achieve more assets with less time and effort by having a solid financial plan in place. So here is what's happening to the 80% of the agent, or the agents who are not here, who's not thinking about incorporation. You've successfully sold some houses. Congratulations. The commission goes to the brokerage and then your personal account. For example, if you kept at 16,000, meaning that you need to make about 44 grand in commission in order for you to cap. If your average get paid by 2.5%, that means you've sold 1.77777 in real estate value. So that should be the goal for everyone at your brokerage, Andrew, if you agree. I don't know, and more than that. You put about 28 grand into your personal account. You probably have an option to ask the brokerage to withhold some tax, for example, 30%, if you're expecting to pay higher tax for the whole year. But those tax that they're gonna withhold, there's no interest for the entire year. Let's just pretend that is not the case. When the money flows into your bank, what do? You spend it. There are bills to pay on the daily, weekly, and monthly basis, but your income is not stable. What happens at the end of the year? Potentially, you could overspend it. Now, the tax bill comes. What can you do? Now, let's take a look at the 20% who are thinking and going to incorporate. What can they do in return of the financial planning to business themselves and the business? The other 20% now are having the opportunity to incorporate. The money do not go into your personal account, but instead your corporation account. For that, it diversify into paying yourself either by salary or dividends. A second account is the tax account that you put the tax money away that could maybe potentially generate some interest. Business account to continue with the marketing, developing, and growing your business. Now, it is your build wealth account. Where do we put the money? I'm sure you're very familiar with the real estate part. Some are familiar with most of the investment part, but let's dive into passive income and retirement later on. I'm not sure if we're gonna be able to have time today, but maybe if you guys want, we can set up a second section for just talked about specifics in the future. But please know that the percentage are not to the teeth because every client is different in terms of income, tax, and expense. This is an idea to show the difference, but the numbers should be based on the needs and analysis that we do one-on-one. Advisors. Why do I want an advisor when I already have my accountant and lawyer? The accountant and the lawyer look at the past and the present, but financial advisors look at the present and the future. A holistic advisor could make you 2.73 times wealthier in the long run. We do not only build your net worth, but also protect your wealth and make sure you retire with confidence. Let's not get into like all the small numbers and fine prints here. Okay, before you're getting tired of listening to me talking forever, it's my honor to have Tony here today to join our webinar. So Tony has been in the business for over 40 years. He's been a director for over 21, and he's been with Sun Life for 11. Tony lives in Toronto, who is very skilled with the in-depth knowledge for incorporation. We focus together on tax-efficient solutions, especially for business owners and strategies behind all of the layers. Without further ado, let's welcome Tony, and please take it away.
Thank you, Vicki, and thank you, Andrew, for this opportunity. And to all of you on this session, thank you as well. By the way, what Vicki didn't say is under the COVID circumstances today, Sun Life actually accorded me as a director the opportunity to take a health and wellness day off. So I'm actually off. I should not be working. I should be looking after my health and wellness. But Vicki came to me at the last minute a day or two ago and said, look, I've got this situation going on. I'm speaking to a really good group of professional real estate folks. And could you talk about some insurance and estate planning and all the lovely stuff that I'm sure you're dying to listen to? Nothing better than getting friends and family and colleagues around a barbecue and talking about death and dismemberment, isn't that a fact? But Vicki, thank you again, and Andrew, thank you for the opportunity. So I'm going to share my screen. Oh, well,
yeah.
Okay.
All right. Okay, so I'm going to have to tell you how to move these slides. Is that right?
Tony, you can do it. I just made you a host.
I could stop mine here. Hold on.
But do I have to share my screen, Andrew, to do that?
You should be able to share your screen now.
Yeah, but I don't have the presentation. Vicki does.
Okay. All right.
So I'm going to stop sharing, Vicki. You have to. So yeah. Okay. So let me see if I can. Yeah. So I can move the slides. I can't. So I'm going to tell you to move the slides, and then you do that. All right. So again, thank you, folks. I'm not sure, again, just out of humor, whether, Vicki, you said 20% of my clothes in my closets are worn 80% of the time, or is it 80% of my clothes are worn 20% of the time? I'm still have to figure that equation out. But, I know, isn't it? Having said that, what I wanted to focus a little bit on today, and again, we can go into all kinds of information. So I want to talk about, okay, now you have this great opportunity. You have the opportunity as a real estate professional to incorporate and create what they call a CCPC, or a Canadian controlled private corporation. But with that comes, why are all the reasons you do that? It's to defer from taxation. It's to defer your income from being taxed so that you can actually have access to the small business tax rate that Vicki alluded to, which is 12.2% on your first $500,000 of income, and 26.5% on your next $500,000 of income. So unlike somebody like me, who is, it's all right. Unlike somebody like me who's an employee with Sun Life, and Sun Life pays me handsomely, if I may say so, I'm taxed based on that grid that Vicki showed you earlier at literally 53% at my top marginal tax rate. Now think about that. I pay 53% on my income. You have the opportunity right now to pay 12.2% on the first $500,000 you make and 26 on the income above a $500,000. At 10 million, doesn't matter, it's all 26 and a half. But you do have the opportunity to really reduce and minimize the taxes on your income that I don't. That's the benefit of having a professional real estate corporation. Next slide, Vic.
Yeah.
So let's understand the layers of taxation. This is you. On the right, on the left-hand side, that's your corporation. One day, let's assume it has a ton of money sitting in it. And as Vicki said, at death, you're deemed to have disposed of all your assets. So the fair market value of the shares of your corporation are now taxable. CRA comes calling. Death and taxes go hand in hand. You have to pay the Pied Piper. Now, the fair market value of your shares on that left blue bar, that's triggered as a disposition on death. So what happens is that your taxes are taxed as a taxable dividend in the hands of your beneficiaries. What we don't realize is that there is a second layer of taxation on your terminal tax return on capital gains. And you guys know all about capital gains because you sell real estate. Real estate is a capital gain or a capital loss. And when I sell my property that isn't my principal residence, it's taxed as capital gains. And I will share an idea with you of how people like Vicki and I and Olivia work with real estate agents like you to combine banking, insurance, and real estate. So now you've got these two layers of taxation. The only way you can mitigate and minimize some of those taxes is by creating something called a credit to your capital dividend account in your personal corporation. Let me repeat that. There is something called a CDA, capital dividend account. That's that gold bar on the side with the question mark. It's a notional account that you can register with the Canada Revenue Agency. And the reason you do that is to flow money out of that capital dividend account as a tax-free capital dividend to yourself or shareholders of your corporation, could be your family members. You would want to have a good accountant so that those three acronyms at the bottom on the right-hand side, which says LCB, LCB stands for loss carry back, where you can apply capital losses against capital gains on the sale of real estate, as an example. Or pipeline planning. You might decide to dissolve your corporation and create a new corporation and transfer the fair market value of your shares to the new corporation to eliminate any taxes. Now, this is all at death. If we go to the other slide. What about during life? Well, here's what happens. So now you created this corporation. You're starting to put investments in that corporation. It's non-registered. It's not an RSP. It's not a TFSA. So an RSP is a registered retirement savings plan. A TFSA is a tax-free savings account. You can't put those in your corporation. You have to hold them personally. But what about your investments inside? So the excess money your PREC is generating, where do you invest? You have to decide, do I invest back in real estate, which I can sell to myself as an investment property? Do I buy GICs? Do I invest in the stock market? But the fact that it's non-registered says that there's annual tax on the growth and there's tax on the dividends when you withdraw or pay yourself out. When you liquidate those investments, there's tax on deferred gains. Much like you hold an investment property, i.e. real estate, you sell that property off, it's not your principal residence, you have to pay capital gains taxes. If you die, there's a taxable dividend, and you can see that the huge portion of that goes in taxes to CRA. In fact, they say, look, you only have 3 beneficiaries in life. Your loved ones, your favorite charity, or the Canada Revenue Agency. Next slide, Vicki. So what CRA has done, they've created some punitive damages, i.e. when you earn a lot of passive investment income. So remember, passive investment income is the money you're making in your real estate corporation that you're investing somewhere. You're not using it for business purposes. you're putting it into savings. And you can see that for every dollar on the right side of passive investment income generated by your real estate corporation will reduce the small business tax rate by $5. So every $1 you earn is going to be multiplied by 5, and that $5 is going to reduce the small business tax rate. Next slide. So here's an example. Let's say you're making X amount of dollars each year in your operating company, which is your real estate business. You then decide to move it into savings, which is called passive investment. It's not active business income, it's passive investment income. So let's say your corporation generates $60,000 of passive investment income each year. CRA says that the first $50,000 is exempt from taxation. The next $10,000, which is the excess over the 50, is multiplied by 5. Now that 10 times 5, which is 50,000, reduces your small business tax rate. So that 50,000 is no longer taxed at 12.2%. It's taxed at 26.5%. So if you go to the next slide, Vicki. This says that if you're generating 150,000 right on the right side, $150,000 of passive income, you no longer have access to the 12.2% small business tax rate, which is denoted at the bottom of the slide. That 150,000 will be taxed at 26.5. You either better have a great accountant, or you better find ways to invest money that reduces that passive investment income generated each year. I think what Vicki is trying to do with this session is say, look, there's a lot of great information that you need to be aware of from a tax perspective. Go to the next slide. So let's look at the flow of money here. Right at the top, you've got your operating company, your real estate company. It's active business income. Your holdco, let's assume you can have a holdco, which is where you hold your money and your savings and your investments. So it's money. So let's go back to your real estate corp. Let's say that's your opco. The first $500,000 of commission income is taxed at 12.2. Anything over $500,000, as I keep mentioning, is taxed at 26.5, the general tax rate. So gross revenue or commission comes in income, top shelf. You now claim your deductions. So as an incorporated professional in Canada under the Income Tax Act, you can now claim, that's the whole purpose of incorporating, so that you can claim these deductions, i.e. salary to you, salary to your staff, utilities, hydro, mortgage, whatever your expenses are, you deduct that. That leaves you with net income pre-taxes. Then you pay taxes now at 12.2 on the first $500,000, 26.5 over half. That's net income after taxes. Now what do? You've already paid yourself salary. That's box number 2. So now you pay yourself a dividends because you're the shareholder of your personal real estate corporation. Whatever's left over is either retained in your corporation for future expenses, or it's transferred and invested on the right side. And you invested in fixed income investments, stocks, equities, real estate, which is what you guys are probably going to do more often than not. You buy real estate. Permanent life insurance. Go back there. So these are the 4 boxes. These are called asset classes. Now here's the key. The top 3, which is fixed income, stocks, real estate. If that real estate isn't your personal residence, all of the 3 boxes there are taxable. The only box that's not taxable as an asset class is the one right at the bottom, which is what Vicki wanted me to speak to you about. I can go to the next slide. So here's a rhetorical question. I'll answer it for you, but I just want to have a bit of fun. What do you believe under the Income Tax Act are the 4 permanent tax-free vehicles in Canada? What do you think they are? In other words, you invest, the money grows tax deferred, you don't pay any tax on the growth or the investment growth in the product or the vehicle, i.e. the instrument, and you die, it pays a tax-free. You can even get the money out tax-free. Go ahead, Andrew.
You're on mute, Andrew.
Thank you. I'm going to assume you're talking about a permanent life insurance, registered retirement savings, the RRESPs. So I only have, and tax account, TS.
TFSA. So 2 of those were right. 2 of those no, because an RSP and an RESP.
50% is about the marks I got in school too.
Yeah, you go. So that's good enough. But you'll be actually quite amused at when you see the list. But don't show it right now, Vicki. So let's talk about the RSP, because that's a very oft answered or an often answer to that question. But RESPs are registered education savings plans on your children and registered retirement savings plan on yourself are taxed when you withdraw the money. And when you die, the value of those 2 accounts as well is taxed in the hands of your children. You can defer it to the death of the second spouse, but it's taxed, somebody pays tax at the back end. So it's not a permanent tax-free vehicle. So let's look at the 4. Bang, show it off, Vicki. TFSA, as Andrew, you said. So tax-free savings account, which I think is about $6,000 a year, maximum, I don't know, what, 70,000, Vicki? Something like that over your lifetime, but 6,000 a year, right?
Yeah, it's 69,500 right now if you have not deposited anything. But you're right. Yeah.
6,900? Okay.
Oh, sorry.
That's not a lot. That's not a lot if you're making a lot of money as a, yeah. That's not a lot if you're making a lot of money. But what that means is that the money grows tax-free, and when you pull it out, it's tax-free. And if you die, it's paid tax-free to your kids or your favorite charity. What's number 2? Oh, wow, look at that. Your personal residence. And that falls right into your wheelhouse, your personal residence. And some of you, in fact, all of you should have got that.
Yeah, I feel
personal real estate residence. Right? Because we know, and we tell clients this all the time, Vicki will tell clients, buy the biggest house you can from your real estate agent. Why? Now, you can only claim 1 personal residence at any given point from a tax perspective to be exempt from tax. You can have multiple residences, but only 1 is your principal residence at any given point. But we tell clients, buy the biggest house you can, go and speak to your real estate agent, buy the biggest house you can because it's exempt from taxation on the growth today while you're alive, when you sell it, and if you die. What's number 3? I bet nobody would get number 3. Winning the lottery. Lottery winnings, Lotto Max and Lotto 649, or even going to a casino and winning a big jackpot in Canada is tax-free. And Vicki will tell you, we tell clients, look, if you play the lotto all the time, we'll build it into your financial plan and put it into your budget. I know I buy tons of lotto tickets. I've never won. 40 years, I'm still waiting for my jackpot. But you never know. So winning the lottery. And number 4, as Andrew very clearly said, is permanent life insurance. So these are the only 4 permanent tax-free vehicles in Canada under the Income Tax Act. The question that you need to ask yourself, or for that matter, clients of yours, are you maxing out your TFSA? Have you bought the biggest personal residence that you can? Are you playing the lottery? Maybe you don't like gambling, that's fine. How much permanent life insurance do you have in your portfolio? At least TFSA, personal residence, and permanent life insurance should be in every Canadian taxpayer's portfolio. Why? Because they're the only ones that are permanent tax-free vehicles in Canada. And it's funny how nobody takes advantage of one on the left, TFSA. Nobody maxes out their TFSA. Nobody maxes out their life insurance. People do own personal residences. They know that through people like you. But do they buy the biggest house possible? Do they buy investment properties? All right, next slide. So, understanding what matters to clients. Here are some tax efficient solutions for you as a business owner. Are you maxing out, number 1, your RSP, which is your, as Andrew said, registered retirement? It doesn't, even though it's not a permanent tax-free vehicle, it's tax deferred. So you want to max out your RSP. You want to max out your TFSA. Do you invest once you start to make money? Are you investing to defer or eliminate capital gains? Where do you find those? Corporate class mutual funds. You can defer taxes on that inside your corporation. Real estate. Put real estate inside your corporation. Again, principal residence. IPPs. Should you consider really having the best individual pension plan that you can? What is an individual pension plan? It's a supersized RSP. An RSP, again, Vicki, I'll defer to you. What's the max RSP contribution you can make in 2020? Is it like what, 26, 27,000 a year?
It's 16% of your income, but yes. So if
18% of your income.
Here, I'm gonna give you the exact amount because this is something boring, but again, it's very useful. So TFSA is 69,500, and then RSP is 18, so 27 to 30.
So 27,000. Thank you for that, Vicki. So what happens if you're making so much money and you've maxed out on the 27,000? An IPP number 3 allows you to supersize that. You can actually get into the hundreds of thousands and put it into that pension plan. Why? Because you're deferring from taxation and you're creating this incredible wealth portfolio that one day you're going to use if you decide to retire, or for that matter, just trigger it. Number 4, charitable donations from a private corp. You can actually donate to charity if that's your bent, if you're philanthropic. You can donate shares of your private corporation to a charity and claim deductions on your tax returns or at death. Now, you might say, well, hold on a second. My personal real estate corporation is valued at, let's say, 1 million. And the shares of that, maybe I want to donate 200,000 to my favorite charity. But what happens to my children or my spouse? They lose out on that 200,000. You put a $200,000 life insurance policy inside your corporation to redeem the shares of that, of the amount that you've donated to charity. That's what number 4 is. What about creating this capital dividend account? So that's 5A and B. Pay tax-free dividends to shareholder via this capital dividend account. I can't speak enough about this CDA. I'm not a tax accountant, but when I say I can't speak enough, meaning I can't tout the value of the CDA and why you need to know how important this capital dividend account is once you decide to incorporate. And your accountant will share enough information about this. What I want to focus for the remaining, let's say 5-10 minutes, if I do, is corporate and term life insurance, because that's my expertise. I've been doing this for 40 years for people like you and clients like you, but more importantly, real estate professionals like you. So Vicki, if you don't mind going to the next slide. So here is why. Remember, I spoke about the 4 things that winning the lottery, TFSA, life insurance, and real estate. Well, here's the key benefits of owning permanent life insurance inside your corporation. All the money you invest in that policy, first and foremost, what is life insurance? You die, boom, a lot of money goes to your spouse, your partner, your favorite charity, your children, so that they can live comfortably after you're gone, and or you reduce taxes. So, but everything you invest in that policy while it's sitting in your corporation is tax preferred. You're not paying any taxes on that. Investment growth. On the extreme right-hand side, you die, it's tax-free at death. And I'm going to show you ways of how you can access the money that you've invested in your life insurance in a tax-free way. Next slide. So let's look at a typical client. Between the ages of 35, 65, you're generating a fair bit of money in your real estate corporation. You want to minimize taxes today. You want to minimize taxes when you die, but you also want to diversify your investments to create wealth. Next slide. So let's look at this. This is you or a client of yours. Money is sitting in the corporation, it's invested. Now, as I said, it's not a TFSA, it's not an RSP, because you can't put either of those 2 registered plans inside a corporation. So those are non-registered investments. They're taxed annually on the growth, or they're taxed on a deferred basis. and they're taxed at death. Now, moving along that grid, you can see it says dividend paid by your corporation to you as the shareholder. So let's say at age 65 to 74, you decide to pull out 100,000 as income. Well, that's pre-tax. So at a 40% tax rate, you're going to pay about 40,000 of taxes on that. So you're left with 60,000. You can see now whatever investments are sitting in your corporation, and I'm just using a hypothetical example out here. This is a 45-year-old person. They pay 700,000 in taxes, 1.3 goes to their kids. What we're suggesting is why not add permanent life insurance to your investments as an asset class? The same amount of money that you're putting in your investments, put in your insurance. You can see what happens right off the bat. No tax on the growth and tax-free at death. You then assign that policy, and this is where you guys come in. So here's what I do a lot, and I want you to really please, if I can ask you. So I do something called, now at the top, which is the heading, it says a corporate insured retirement strategy. What I do is something called an immediate finance arrangement. What is an immediate finance arrangement? It tells a client that if you have a major life insurance policy in your corporation, you can see the blue box at the bottom, assign policy today or years later to the bank, and the bank will loan you back against the cash or the equity. It's a home equity line of credit, except you're using your life insurance equity. So let me repeat that. As real estate professionals, we know, sorry, I'm not a real estate professional, but you know, that I can take my home that has equity in it, assign it to a bank, and say, it's valued at $1 million. My mortgage is $200,000, which means the equity in that home is $800,000. I can borrow against that equity, correct? If I invest that equity, which is a home equity line of credit, I can claim deductions on the interest I'm paying on that loan, and CRA legally allows you to do that. So what we're saying out here, by the same token, you're using the same principle of a home equity line of credit, except that you're using the equity in your life insurance policy. And you can see that at the bottom there in the middle, it says loan to corporation or shareholder. So much like your home equity line of credit, the bank will loan the client or you back based on the equity in your policy, either to your corporation or to you as a shareholder. And you can see same 100,000, except that 100,000 now is coming to you tax-free. You move along that grid, 1.3 million on the top where it says the estate pie slice, but 2.2 is your life insurance. So you're actually leaving $1 million more to your beneficiaries, but you've been able to do the same thing using real estate. Because what happens is when clients borrow against their life insurance policy, they can invest in real estate. So what they end up doing is they actually end up buying an investment property from you. Because they're investing that money in real estate to get rental income, they are now claiming deductions on the loan interest that they're paying to the bank. So what you've actually showed them how to do is use life insurance to buy real estate and claim deductions. That's the clincher. That's the money shot. If you want more information on how all of this works, by all means contact Vicki and she'd be more than happy to share it. Where I wanted to go with this slide is the fact that what we do is we insure clients so that they protect their homes, they protect their families, they protect their wealth. But on top of that, they can also obtain a similar to a home equity line of credit, an insurance line of credit, using the equity in their policies to generate wealth and invest back in real estate. This slide and this information should be, I think, very, very vital. Well, sorry, let me take that back. Not vital, but very informative as to how you can actually grow your business using insurance and real estate together. Next slide, Vicki. Actually, so I'm finished my portion, but I'm happy to answer any questions. Andrew, if you want to throw the line open to before Vicki closes it off for the last couple of minutes, more than happy to answer questions today that you might have, or if you have questions that come up in mind, by all means, flow them through Andrew and Vicki, and more than happy to answer any questions at a future date. But any questions right now, either by chat or unmute yourselves. Anything that I covered didn't make sense? Any further questions?
So my first question about permanent life insurance, when it's owned by a corporation, it's still within the corporation. So you're still going to have to get it out of the corporation and pay taxes on those funds as it come. Like if you've died, money is still in the corporation, right?
Yeah, so good question, Andrew. But remember I said that CDA, that capital dividend account?
Yep.
Life insurance flows through that capital dividend account tax-free. So that's how you get any money out of your corporation tax-free. Doesn't matter if it's life insurance or anything else. Any money that flows from your corporation that's tax-free to any shareholder of the corporation, including your beneficiaries, can only flow out through this thing called the capital dividend account. That's the only way you get money out. Life insurance, the Income Tax Act allows you to flow life insurance through this capital dividend account as a tax-free capital dividend. That's how you get the money out tax-free.
Okay. And is there limits to how much you can get out, and like how does that work? Can you expand on that a little bit?
Yes, that's also a very good question. So there's something called an ACB, which I'm sure all of you are accustomed to, an adjusted cost base. Using real estate as an example, so let's say I bought a property for $1 million. That's my ACB. It's owned by my corporation. It's now worth $1.5 million, and I die. Or I decide I'm going to pay it out through my capital dividend account. Well, the ACB, anything in excess of the ACB is tax-free. Anything up to the ACB is taxable as a dividend. So in your real estate example, 1 million would be a taxable dividend. The 500,000 of capital gain would be tax-free through the CDA. Life insurance works on the same principle. Whatever you invest in a life insurance policy, so over 10 years, let's say you invest 100,000, $10,000 a year. That $100,000 is a taxable dividend, but your death benefit is $1 million. So 900,000 is tax-free through the CDA, 100,000 is a taxable dividend. But here's the great thing about life insurance, unlike real estate. That taxable portion goes down each year. And when you finally get in your 70s and 80s, that taxable dividend is zero. So that entire life insurance pays out tax-free through the CDA. And you can see that right from day one, what that ACB is going to be each year. So how much that ACB is taxable, anything over the ACB is tax-free. Now with life insurance, it's exponential. Your ACB could be, as I said, 100,000, but your life insurance death benefit is $1 million. So 900,000 is tax-free, 100,000 is still paid out as a taxable dividend. But that 100,000 keeps going down. So eventually it gets to zero. I don't know if I answered that question or.
And is there a limit in how much you can pull out through those dividends?
No,
or,
not at all. If your life insurance policy is 10 million, so assuming you could get a $10 million life insurance policy, it's inside your corporation. If the ACB on that 10 million is 1 million, then 1 million is taxable, 9 million is tax-free. There's no limit to how much you can get out. The limit is how much insurance you could buy. And so the insurance company places limits on how much life insurance you can own inside your corporation based upon how much your corporation is earning. So if your corporation, normally they use 10 times as a general rule of thumb. If your corporation is generating 100,000 of income a year, you can get a $1 million life insurance policy. If your corporation is generating $1 million a year in income, you can get a $10 million policy. And in answer to your question, that entire $10 million now can go through that CDA. tax-free to your beneficiaries. Look, I've been doing this now, and as Vicki said, for over 40 years in Toronto. And it's amazing how the wealthy become wealthy because they use other people's money. They use real estate and insurance. As I mentioned, the four tax, forget the lotto. The TFSA is negligent, right? It's like 69,000 lifetime. Real estate and permanent life insurance hand in hand are just the most incredible wealth building opportunities. Canadian taxpayers don't really understand this stuff. Only the high net worth clients do. People that you might come and access or in contact with or have access to. People that buy large real estate properties from an investment or a principal perspective. And then they back it up with life insurance so that the life insurance pays off all the taxes at the back end, but also creates tax shelter and investment growth while they're alive. That's the only reason Vicki wanted me to come on this panel with you today, is to share this sort of information. You guys are at the cusp of something incredible. You now have the opportunity as real estate professionals to create your own corporation and take advantage of some of these incredible tax-free vehicles. And even tell your clients about it. Why should you buy more real estate? Back it up with some life insurance at the back end. This thing goes hand in hand, Andrew. I hope I was able to shed some light and some information. I know I get excited and passionate about it, but I do because I understand what it is. And I've been doing it for 40 years and I've seen a lot of people grow wealthy.
You're amazing, Tony. Thank you. Thank you so much. Andrew, do you have any more questions or should I just go with the closing?
I don't have any more. If anybody else has any, they can certainly unmute themselves and feel free to ask.
Or send Vicki or you an email or by email at a future date. Some questions might arise tomorrow, a week from now. I heard something on that presentation, not sure how it worked exactly because it was quite laborious or whatever the case might be. But I do have a question that's come up. I've spoken to a friend or a family member, et cetera, et cetera. By all means, channel it through Andrew, channel it through Vicki, and happy to work with both of them to bring you any answers or any information that you need. But I do thank you for the opportunity to be on this panel today. Appreciate that. Thank you, Andrew.
My pleasure.
Okay, so as Steve was saying last time, that when someone was asking about corporate-owned life insurance, he had shared some of his thoughts of the policies, how it was sold by some of the brokers instead of advisors from the insurance company. So my guess was that they might not have done the proper financial planning at the sale. Either the beneficiary should be the family or the corporation. That was one of the questions that was asked. But at the end of the day, it should not be a choice. Sometimes it should be a combination, but it all depends on the needs and analysis. And often in time, especially for business owners who are in corporate, we communicate directly with their lawyers and accountants to make sure that the planning and the solutions that we recommend, that we advise, are at the best interest of the clients and their family. So in which I look forward to working with Steve and Andy. The last thing that I would like to say for today is that this is something that I say to my clients. A goal without a plan is just a wish. Without an action, it's just a dream. Give me a goal, I give you a plan, but guess what? You're the one who's making your own wishes and dreams come true by taking some actions. Incorporation isn't for everyone, for which those strategies won't apply to you yet. Insurance and investment products are not for everyone neither, but financial planning could be. So tell me, what's your goal today and tomorrow? I don't know if you guys wanted to email me or call me like Tony was mentioning, or if you have any questions, you're more than welcome to reach out or even schedule a one-on-one session. The consultation is absolutely free. Andrew, I don't know if you have the list of the audience who registers, or if you want to give me their email, or if there's anything that they wanted to know, I can contact them and be proactive. We do have a lot of information that we could have shared that absolutely 1 hour is not enough. So if you have any interest, or if you want to do a pool of things that your agents might be interested to know more about, my team and I are happy to help. So this is Tony, he's amazing. There is Paul that I forgot to mention him earlier on the slides, that he's a lawyer with us as well. And Mike, he's investment director, that he's very specialized on investment part. So any questions for me?
Nope, thank you very much, Vicki. We very much appreciate the information, and we'll pass the recording on as well, and hopefully everybody is able to create a wonderful financial plan with your advice.
Perfect. Thank you very much. You guys have a great weekend. Happy Thanksgiving.
Thank you very much.